Let's take a look at Chapter 7. We'll be talking about receivables in this chapter. Think for a moment about what an accounts receivable is. We've talked about this pretty much since, I don't know, Chapter 1 or Chapter 2. But a receivable, or an accounts receivable specifically, is when a customer owes you money for a service or products that you've provided. In other words, you've earned the money, but they haven't paid you yet. So far, we've just looked at receivables en masse. Anytime we've booked to receivables, we've just booked to accounts receivable. We haven't worried about trying to track the customer. But a company must maintain a separate account for every customer inside of its receivables. It doesn't make sense that we wouldn't try to keep track of the balance that a customer owes us, right? Anytime that a customer called and said, hey, how much do I owe you? You don't want to go back to this long, lengthy ledger and try to find every entry that you had for that particular customer to try to add it up. So certainly we're going to keep a subsidiary ledger, and that's what we're talking about here is a subsidiary ledger on each customer. You'll see now that if we use this example of July 1st TechCom having a credit sale of $950 to ComStore and a collection, that when we record the receivable, we now indicate the customer name. And if you'll see here, if this is our master accounts receivable, this is what we've done up to this point. What we're saying now is that we need to have subsidiary ledgers for each customer. Here's the ledger for RDA. Here is the ledger for ComStore. If I were to have a listing of what's in my accounts receivable, all of these would tie together. Let's talk about credit card sales. What's the advantage of allowing customers to use credit cards? Well, first off, customers' credit is going to be evaluated by the credit card issuer. You don't have to worry about whether or not your customer is going to be able to pay you 30 days down the road. That's Visa or Discover's problem, right? The risks of extending credit are transferred to the credit card issuer. Again, that becomes Visa or Discover or MasterCard's problem. Our sales increase by providing purchase options to the customer. Can you imagine if you go into a store nowadays and they don't take credit cards? There's a high probability that you won't buy anything there. Of course, if you're here in Fredericksburg, we know the one place without a doubt that doesn't take credit cards, and we always have cash with us, and that's Carl's Ice Cream, right? Cash collections are also quicker because the credit card company is going to pay us in a certain amount of time. We don't have to worry about chasing a customer down. Here's an example of what happens with a credit card. On July 15, TechCom has $100 of credit card sales with a 4% fee. $96 cash is received immediately on deposit. All right, what's this talking about here? We see that there was a sale, and obviously we've allowed our customer to pay us by credit card. But we're only getting $96 in cash from the credit card company. That's absolutely correct. In this case, it looks like the fee, well, it says the fee here is 4%. That's not completely out of line. Even if you take Square or PayPal, everybody knows about the swipe that you can put on your mobile phone or on a tablet in order to be able to take credit cards. They charge you a fee to be able to accept credit cards. It can be kind of odd, right? I mean, if you think about what this really is, if you were to bill, what, $1,000, your fee would be $40. It's kind of crazy. Those fees are not cheap at all. So it certainly costs a merchant money in order to take credit cards. As you see here, if I've got a sale for $100, but the credit card company only pays me $96, I've got a problem. What am I going to do with that $4? We call that a credit card expense. It's a fee to us, the company who accepts credit cards. In the real world today, we typically call this merchant fees or merchant collection fees, just about anything like that, to signify that this is specifically a fee from the credit card company. And those fees are staggering at the end of the year. I'm not kidding about that. Here we'll look at this one as well. If instead TechCom must remit electronically the credit card sales receipt to the credit card company and wait for the $96 cash payment, we make the first entry on July 15 and the second entry on July 20th. What they're saying here is that instead of like what Square does, Square is going to give you the money immediately. Square will immediately put the $96 in your account. But some merchants, PayPal is one of these specifically, they're not going to put the money immediately in your account. You're going to have to wait a little while before they actually push the money to your account, or you may have to go pull it into your account in the case of PayPal. So when you make the sale, what you really have now is an accounts receivable from the credit card company. It's not the customer who owes you any longer. It is now the credit card company that owes you that $96. And then later down the road, when you actually get the money, you're just going to receive the cash and relieve the accounts receivable for the credit card company off the books. All right, what about installment accounts receivable? These are amounts owed by customers from credit sales where payment is required in periodic amounts over an extended period of time. Any situation in which we're going to collect money over an extended period of time, we should consider the fact that interest might be a factor. You'll see here Ford Motor Company reports more than $70 billion in installment receivables. That's because Ford Motor Company has their own credit card agency as well. All right, let's talk about valuing accounts receivable. What happens when the customer doesn't pay you and they're not going to pay you? They're absolutely refusing to pay you. No matter what the reason, uncollectible amounts are going to be referred to as bad debts on our books. We still made the sale, right? We're not going to reverse sales out because we still made the sale. We're simply unable to collect it. There are two primary methods of accounting for bad debts. The first one is the direct write-off method, which is pretty easy, I'll be honest. And the second is going to be the allowance method, which has a few subparts to it. Let's look at direct write-off first. In this example, TechCom determines on January 23rd that it cannot collect $520 owed to TechCom by its customer Jay Kent. What do? Very, very simply, in the direct write-off method, we're going to push $520 into bad debt expense, and we're going to take the accounts receivable for Jay Kent off the books with a credit of $520. Again, notice that the specific customer is going to be noted in that transaction so that we can put it on that customer's subsidiary ledger. It's probably also a good idea to make sure that subsidiary ledger is marked as a bad credit client. You don't want to sell anything else to Jay Kent on credit for sure. What if Jay Kent suddenly finds a heart and says that he wants to, well, I shouldn't say it that way, maybe he finally comes up with the money and decides to pay it off. So on March 11, Kent was able to make the full payment to TechCom for the amount written off. What are we going to do? Well, first off, we need to reverse that entry that we just made. We need to take bad debt expense off the books and restore the receivable with a debit of $520, and then we simply receive the cash like we would in any case. What's the problem with the direct write-off method? Well, it usually doesn't match sales to expenses. Why do we care about matching sales to expenses? Well, because the matching principle, remember this, requires that expenses be reported in the same period as the sale they helped produce. What does that all mean? Let's just go take a look real quick again. We sold to Jay Kent, I don't remember exactly when it was, but it was probably before January of whatever year this is, right? So now we're recording an expense in January. We might have made this sale in November. The matching principle says that expenses that are related to revenues need to be recorded in the same period. So the direct write-off method really doesn't allow for that at all. The revenue's back in November, and now I have a related expense in January. Furthermore, now I'm moving even a few months more ahead, and I'm actually reversing that out in March. So really matching is just completely out the window. So that's about the matching piece, and that's why the direct write-off method, by the way, is not a generally accepted accounting principle. However, there is a materiality constraint inside of the principles that says you can ignore an amount if its effect on the financial statement is unimportant to business decisions. In other words, if that $520 really isn't going to make a difference to someone who's reading the financial statements, let's say that this is a multi-billion-dollar company and that $520 is the only write-off they ever have, the materiality constraint says don't worry about using any other method other than the simple easy one, because $520 really doesn't matter to the reader when we're looking at a multi-billion-dollar account. Okay? Materiality. All right, so what about the other methods? That was the direct write-off method. That's all there was to it. Let's move on into the allowance method. First off, the allowance methods are generally accepted accounting principles. because it actually does match up the expense in the period with the revenue. But I'm just going to go ahead and say this right now that it's a big guess. Like a lot of things in accounting, it's a big guess. Again, we're going to estimate bad debt expense in the period that the related sales are recorded. This is what gets us into the matching principle. And it reports accounts receivable on the balance sheet at the estimated amount of cash to be collected. That's what's good about the allowance method. So let's see what happens when we use the allowance method. By the way, the allowance for doubtful accounts is a contra asset account. It's going to be presented on the balance sheet as a part of accounts receivable. It's actually going to negate accounts receivable. Let's take a look at this example. TechCom had credit sales of $300,000 during the first year of operations. At the end of the first year, $20,000 of credit sales remain uncollected. So we don't really care about the $300,000 except for maybe making our estimate. So we have $20,000 credit sales remained uncollected. That means accounts receivable has a $20,000 balance. You can see that down here. Based on the experience of similar businesses, TechCom estimates that $1,500 of its accounts receivable would be uncollectible. So we've looked back at trends and at history. We're saying, you know what? We think that based on our experience of this type of receivable or this much sales, about $1,500 we're never going to be able to collect. So we're going to go ahead and estimate that $1,500 is going to be bad debt expense for December, and we're going to record that now in basically what's kind of a reserve account for this allowance for doubtful accounts. Here's what it looks like on the balance sheet. Like I said, the allowance for doubtful accounts is going to be a contra account, and it's going to be presented on the balance sheet along with accounts receivable, either as a separate line item to give us a net accounts receivable value, or as a single line item and then disclosed in parentheses, showing that it's net of 1,500 doubtful accounts. In any case, we see that we believe, this means that we believe that we're going to be able to collect $18,500 out of our $20,000 receivable. All right, so how do we actually write off a bad debt? When J. Kent actually does not pay his bill and we determine that it's uncollectible, how are we going to deal with that now that we're not using the direct write-off method? Well, it's pretty simple. We're certainly not going to put it in bad debt expense. Remember, we already put $1,500 in bad debt expense. This $520 is just a part of that $1,500, right? So what we're going to do is we're going to take his receivable off the books with a credit, and we're going to push the debit now into our allowance. It now uses up some of our allowance or our reserve for doubtful accounts, and that's exactly why we call it an allowance. We've already reserved about $1,500 to be used up, and now we're using up $520 of it. All right, notice that the write-off doesn't affect the realizable value of accounts receivable. Before we actually did the write-off, remember, accounts receivable was a debit of $20,000. The allowance was a credit of $1,500, giving us a net realizable value of $18,500. After the write-off, it's exactly the same because we're still using the same $1,500 reserve. We're still using the same thing. You might be wondering exactly why did it happen like this. I'm going to back up one screen because right here, that 520 we pulled some out of here and we pushed it right over here. So it becomes the same net realizable value. How do we recover it? Just like we recovered a direct write-off, we're just going to reverse the entry where we took it out of the allowance, and then we're going to collect the cash. All right, so now that we've seen the direct write-off method, we've seen the allowance method as a whole, let's talk a little bit more about this allowance method and the fact that it's an estimate. We estimate the bad debt expense. Well, how do we ever figure out what our estimate of bad debt expense is? Again, you can only do this under the allowance method as it would be. You can't do it under the direct write-off method. Direct write-off is the actual receivable. So how do we estimate it? Two methods, the percent of sales method and then the accounts receivable method, which has two variations, basically, I guess is the best way to say it. First thing I want to tell you is that the percent of sales method is almost going to always require that you make some adjustment to your allowance account down the road. because when you use the percent of sales method, you're just going to keep building that allowance account up. What if you never take anything out? Is it just going to keep getting bigger and bigger and bigger infinitely? No, you're going to eventually have to adjust that amount down to something that's more reasonable. However, the accounts receivable methods are self-adjusting. You never have to really think about adjusting that allowance account because the percentage that you use is always based on your ending receivables amount. Let's take a look at these to explain a little further. First, in the percent of sales method, it's easy. That's the good thing. This is an easy method, but it is going to create a problem down the road. How do we compute it? We simply take current period sales and multiply it by some estimated percentage that you've based on some trend, some history. Management has made a decision. Here's what it would look like if Musicland has credit sales of $400,000 in 2015 and it estimates that 0.6% of credit sales will eventually prove uncollectible. It's basically just going to charge $2,400 into bad debt expense, push the $2,400 into the allowance. We already know how to do it. We already know how to do the journal entry. It's how did we get to the $2,400? In this case, it was simple. A percentage of credit sales in this. It could be a percentage of total sales. It could be a percentage, well, it shouldn't be a percentage of cash sales, right? Because you've already collected that. All right. The accounts receivables methods, though, this is the other one that becomes quite self-adjusting. We compute the estimate of the allowance for doubtful accounts by taking our year-end accounts receivable and multiply it by some bad debt percentage. However, we're going to take that total estimated bad debt expense, what we calculated here, minus whatever our previous balance in the allowance account was, and that's what's going to give us a current bad debt expense. This is the one that makes the account self-adjusting. You probably need to see it to understand it. I could say it all day long and you'd probably never get it. Watch this one. Musicland has $50,000 in accounts receivable and a $200 credit balance in the allowance for doubtful accounts. Okay, we've got $50,000 is our balance in accounts receivable, and our unadjusted balance basically in the allowance for doubtful accounts is $200 at this point. All right. Past experience suggests that 5% of receivables are uncollectible. So what are we going to do? We're going to take our receivables balance of $50,000 times 5%. That tells us what this means is that our balance in this account, our balance in the allowance for doubtful accounts needs to be $2,500. How do we get it there? We need a credit adjustment of $2,300 to bring this balance up. Before, you were making the adjustment up here using percentage of sales. You were making that adjustment up here and then changing the ending balance to be whatever it was going to be. But in this case, we're trying to find what we want the ending balance to be, and that's why it becomes quite self-adjusting. There's one other secondary method, the aging of receivables method. This one's kind of crazy. We don't see a lot of people doing this, maybe in a big organization that has a lot of receivables, maybe like Ford Motor Credit Company because they have a lot of receivables. They might use this method, but really what's happening here is we're going to take the total receivables and we're going to split it by how far past due certain customers are. So if they're 30 days past due, 60 days, 61 to 90, over 90 days, and we're going to give it a different percent uncollectible to determine what we want our allowance accounts ending balance to be. So that's the percentage of aging method. And you'll see we make the same entry. If we had $200 already in the account, we need a $2,070 credit adjustment in order to make the account balance be $2,270. Summary of the methods. If we look at the income statement focus, again, this is all on the allowance method, not the direct write-off, only on the allowance method. The income statement focus is going to be the percentage of sales. It's going to require an adjustment entry down the road. The balance sheet focus is an emphasis on realizable value. This is the one most accountants are going to prefer, and you're going to do either percent of receivables or aging of receivables. Finally, we're going to get into notes receivable. What is a note receivable? It's a promissory note that is used in a specified amount of money, usually with interest, usually to convert an accounts receivable over into something that's more extended. For example, if a customer comes to us 30 days after they bought something, they were supposed to pay us within 30 days, they come to us and they're like, you know what, I'm just not going to be able to pay it, I don't have the money right now. Can I pay it over time? Can I pay it 3 months from now? That's what we're talking about here. We convert the accounts receivable into a note receivable, and we say, sure, you can pay us in 90 days from now, but you're going to have to pay us interest on the money. All of these things, all of these elements are supposed to be explicitly stated in a promissory note because this is a legal document. And in order to make it an enforceable legal document, you must have all of these elements. How do we compute when a note comes due? That's first. And then we'll talk about the interest in a second. But how do we compute when the note comes due? Here's an example. On July 10, TechCom received a 1,090-day promissory note. Everybody, you know what, you might think that this is easy. And if so, that's great. Some people really struggle with this, without a doubt. So we know that it's 90 days and it's currently July 10. Well, how many days are in July? Well, you can do the Knuckle Valley rule. Hopefully you know that. I can't show you a camera of myself doing it. So YouTube that one. Someone will show you how to figure out how many days are in the month. Knuckle Valley rule is what we call it. Days in July. There's 31 days and we signed this note on the 10th. Therefore, we have 21 days remaining in July. Well, if you take that 21 plus the 31 days of August plus the 30 days of September, we realize that it only takes us another 8 days in October to get to that 90 days. Therefore, the due date of this note is October 8th. I guarantee this is on a test or the final or something somewhere. So make sure that you know how to do this. You take the current total number of days of the current month minus the date that you signed the note, and then add in the days of subsequent months until you get to the number of days for your note. How do you compute interest? If you don't already know how to compute interest, and I would almost guarantee that 90% of you don't really know how to compute interest, you've just thought that you did. You need to learn this. You really need to make sure that you know how to do this because you're going to use it from this point forward and the rest of 211. Also in Principles 2, you're going to see it, and in just about any business, economics, or accounting class you're going to take at some point, you're going to need to be able to compute interest. So please learn it now. I think that this is just as important as the accounting equation itself, so please make sure that you learn it. All you have to do in order to compute the interest on a note. Now, you have to remember there's a lot of different types of notes. This happens to be a note that the whole note value is going to be paid at one time at the end of the note. That's what we're looking at. That's how we're computing this interest. We're not paying a little bit of principal every month. That's a whole different ball of wax that you're going to learn about later. So this is paying the note back in one lump sum at a specific point in time at the end of the note. How do we compute the interest on that note? We take the principal, it was $1,000. We multiply that by the interest rate. You notice that it was 12% in the example, and you might have been thinking 12% what? 12% weekly, 12% daily, 12% monthly. What is it? Interest rates are always expressed in an annual rate. You've probably seen the three little letters that usually comes after interest rate that say APR. That's annual percentage rate. Interest rates are almost always expressed on an annual basis. So this is 12% per annum. And then you multiply that by time expressed in a fraction of a year. So if you're looking at months and it were 3 months, you'd do 3 divided by 12. If you were doing weeks and it were 6 weeks, you'd do 6 divided by 52. In this case, we're using days. It's a 90-day note, and you're always going to divide daily notes by 360. And it's because we use the banker's rule. It's because there's a certain number of bank holidays, right? I think you can probably figure out what they are. That gets us from 365 down to 360. Not only that, if you use 365, would you all of a sudden have to use 366 if it's a leap year? It just doesn't make sense. So the bank uses a 360-day banker's rule. How does that calculate out? And you need to try this on your calculator. I get a lot of people that do a lot of strange things. They'll take this 90 divided by 360 first to get this 0.25, and they'll multiply 1,000 times 0.12, and then they hit equals, and then they take that answer times 0.25, and they get 30. And that works out great in this one because 90 divided by 360 is exactly 1/4. But what would happen if this were 87 days? This is going to be a really ugly decimal, and it's going to do some intermediate rounding, and it's not going to come out all that great. Listen, this is multiplication and division. Hopefully you remember from algebra class that when you're dealing with a problem that just has multiplication and division, the order doesn't matter. You don't need to put parentheses around anything at all. You only need to do that if you're mixing multiplication and division with addition and subtraction. Literally in your calculator, if you've got your calculator out or open it up on your phone, plug in 1,000, hit the times button, 0.12, hit the times button, 90, hit the divided by button, put in 360, and then hit equals. And you're going to get $30. You don't have to do, it's not hard. You don't have to do anything crazy with this. All right, how do we recognize notes receivable? These are usually recorded in a single note receivable account. We moved it typically from accounts receivable to notes receivable. In this case, I guess the client, Julia Brown, she just told us flat out she's not going to be able to pay us in 30 days. Let's turn it into a note. So that's what we did. To illustrate this, we simply are going to debit notes receivable just like we would accounts receivable and push it in to sales of $1,000. Okay. What happens when the note gets paid off? I love how they just change it up on us, right? Let's not keep with the $1,000 note. Let's change it to a $600 note. So let's record a note that's now been honored. I would assume that we issued a note. It was for receivables. It was for an accounts receivable that was transferred. We issued a note to Jay Cook for $600. It was 15% and 60 days. Okay, we did this. It looks like we got it on December 4th. You see what happens? We got the note. We got it paid back to us, the $600. We got the interest. How do we calculate that? 600 times 0.15 times 60 divided by 360 equals 15. Okay? It was due to us on December 4th, so we get cash of $615. That's the note plus the interest. Okay? What if they couldn't pay us? We're just going to convert it back to an accounts receivable. The entire $615, by the way, because now they owe us an additional $15 in interest. You might say, well, why are we going to put it back into receivables? Because this note's gone. The date is passed. We can push it back into accounts receivable and make it applicable under UCC law. Okay, and that has actually a little bit more weight in court. We don't actually have to have a written note in order to collect it under accounts receivable. What about end of period adjustments? What happens if we write a note and now we cross the proverbial accounting cycle date line of December 31? Let's look at this example. On December 16, TechCom accepts a $3,000 60-day 12% note from a customer and granting an extension on a past due account. This truly is accounts receivable converted to a note receivable. When TechCom's accounting period ends on December 31, $15 of interest has accrued on the note. Why do we have to worry about this at all? Remember, when the accounting cycle ends, if you have earned revenue, you must recognize it. It's called the revenue recognition principle. Well, December 31 is the end of the accounting cycle. We signed a note on December 16, so it looks like 15 days have passed till we get to December 31. And on December 31, we have earned 15 days worth of interest. How do we figure it out? We take 3,000 times 0.12 times 15 divided by 360, and we hit the equals button. We get $15. Someone now owes us $15 of interest, and we record interest revenue in this accounting period. What about the next accounting period when we actually collect the note? We're going to collect a total of $3,060. 3,000 times 12% times 60 over 360 days is $60 in interest revenue. So we collect $3,060, we take the notes receivable of $3,000 off the books, but remember, $15 of that interest we booked in a receivable back on December 31, so we have to take that off the books. The remaining $45 out of $60 is interest revenue in this new year. All right, what if we dispose of receivables? How can we get rid of receivables? It's kind of odd to think about. You can sell your receivables. What? What do you mean I can sell receivables? Well, aren't receivables an asset? Isn't an asset something that you own that has value? Remember that receivables is a legal right to collect money. It's actually a legal right. So I can go to the bank if I'm distressed and I need cash, or maybe I just don't want to have to fool with collections. I can take my receivables list to the bank and say, "Hey bank, will you buy this for me?" And they might. It just depends on the risk factor. They're not going to pay you dollar for dollar, right? If your receivables are $20,000, they might pay you something like $17,000 for it because they now have all the risk and they've got to go through all of the collections. So you can sell your receivables to some collection agency or a bank. You can also pledge your receivables as collateral because, again, it's something that has value.